This lecture continues our introduction to international finance by discussing the concept of foreign exchange arbitrage and the applications in covered and uncovered interest parity. What is arbitrage? Arbitrage is a trading strategy that exploits any profit opportunities from price differences for the same item or asset. The goal here is to buy the item where it's cheaper and sell it where it's more expensive. Colloquially, you are buying low and selling high. The presence of arbitrage in any market means that the market for the item is not in equilibrium, for if it were, there will be no opportunities for such arbitrage. Technically, therefore, in equilibrium, a no arbitrage condition is said to hold. Thinking about currency trading and the fact that the forex market is an amalgam of various trading centers around the world, there will be arbitrage opportunities if, assuming negligible transaction costs, the bilateral exchange rate for any two currencies differs across trading centers at a point in time. So if, for example, the US dollar-euro exchange rate in London is 1.10 at this time, and it's also 1.08 in Tokyo, if electronic currency conversions can be carried out immediately from anywhere at either location, then there is scope for currency traders to make profits from arbitrage. Intuitively, dollar holders will buy euros in Tokyo at the lower price of $1.08 per euro and sell them in London at the higher price of $1.10 per euro and make profits. Similarly, euro holders will buy dollars at the lower price of $1.10 per euro, that is, at 0.909 euros per dollar in London, and sell them at a high price of $1.08 per euro, that is, 0.926 euros per dollar in Tokyo, and make profits in euros. From the foregoing though, it's clear that these activities cannot leave the existing prices in the two geographical regions the same. The market forces of demand and supply will therefore act to eliminate arbitrage, as these actions will cause their prices to converge. In Tokyo, the increased demand for euros would cause it to appreciate against the dollar, and therefore cause the dollar-euro exchange rate to rise from 1.08. In London, the increased demand for dollars would cause it to appreciate against the euro, and the dollar-euro exchange rate falls from 1.10. Eventually, the prices converge and there is no more opportunity for arbitrage. In a world of super-fast electronic transactions and minimal transaction costs, this happens very quickly, so that it's a fairly accurate assumption to make when it's said that no arbitrage holds spatially with respect to exchange rates. The question then is, how general is this when thinking about multiple currencies and the possibility of arbitrage through triangular trading? Would a trader make profits from, say, buying yen with dollars, trading the yen for euros, and then buying back dollars with the euros? The answer is quite possibly, but again, market forces will tend to move fairly quickly to restore the no arbitrage condition, which in our example would be when the dollar-euro exchange rate becomes equal to the product of the dollar-yen exchange rate and the yen-euro exchange rate. More generally, for any two currencies, A and B, and with the US dollar as the vehicle currency, there will be scope for triangular arbitrage if the AB exchange rate is not equal to the product of the A dollar exchange rate and the dollar B exchange rate. If they are equalized, then there is a no arbitrage condition that holds. And such a condition is actually very good in the real world when thinking about currency conversions for small countries that are relatively unknown. By using a known currency as the vehicle currency, the exchange rate between these two countries can easily be computed using the formula just described. Let's look now at an example of triangular arbitrage. Consider Jane, who has $6,000 and is in the currency market to speculate. The dollar-pound exchange rate is $1.50 per pound, and the dollar-yen rate is $0.0095 per yen. If she notices that the pound-yen rate is 0.06 pounds per yen, she starts to think that there might be scope for arbitrage through triangular trading. Is she correct? We first check to see whether the no arbitrage condition holds for all three currencies if the yen is the vehicle currency. And immediately we see that it fails, as the dollar-pound rate is not equal to the product of the dollar-yen rate and the yen-pound rate. Actually, the former is smaller, so triangular trading will give her profits. She will buy low, that is, convert her dollars to pounds, and then sell high, that is, she will convert her pounds to yen and then back to dollars. By doing so, she obtains $7,600 and so makes a profit of $1,600. Note that such profitable opportunities will also be observed by other speculating traders, and similar actions will cause the dollar-pound rate to rise while causing the dollar-yen rate to fall and the pound-yen rate to rise. This continues until no arbitrage is restored for these three currencies. We have looked at spatial arbitrage. The exchange rate may also provide for arbitrage opportunities across time when thinking about global financial investment opportunities. When a financial investment is made, the return on such an investment is found by the interest rate. For example, if I invest $200 in a US saving account, in addition to obtaining my principal at maturity, I will obtain any interest that has accrued on that amount. Suppose that there are no restrictions for such flows of financial capital across countries. Then I'm no longer constrained to invest in the US. I have the choice of where to invest, and there might be arbitrage opportunities if I choose to invest abroad as opposed to investing in the US. To see this in more concrete terms, let us use an illustration which we will work with for much of the subsequent discussion. Suppose a businessman resident in Brazil has the option of investing 5 million real in a bank in Brazil that offers 8% interest each year. He, however, sees that Thailand allows for financial capital flows into their country, and banks there offer 10% interest rates on Thai baht deposits. He ultimately wants to hold his money in some investment for a year, and after which he plans to spend it on projects in Brazil. The question is, where should he invest? If we assume he is making this consideration by also thinking he wants to maximize profits from his investment choice, clearly the interest rate differential is enticing. But he needs to ask, between now and a year's time, what will happen to the exchange rate between the two countries? Exchange rates may change over time, as they are subject to events, shocks, and changes in preferences. So long as neither country operates under a pegged regime, for the Brazilian investor to invest in Thailand, he might be interested in covering any risk associated with an adverse movement in the real baht exchange rate that would make that a worse option than the Brazilian investment. In other words, for there to be riskless arbitrage, where he is indifferent between the two investments, he could purchase a 1-year forward contract, such that when he converts his real to baht today and invests in Thailand, after a year, he is able to purchase back real that is no less than the amount that a Brazilian investment would have given him. If such a 1-year forward contract can be found, where the Thai investment provides for arbitrage compared to the Brazilian investment, then Brazilian investors would favor the Thai investment and seek to convert their Brazilian real to Thai baht in order to take advantage of such opportunities. The result is that the baht would appreciate and the real depreciate today, such that only less baht can be purchased with any given amount of real today. And this will continue until the two investments are ultimately equal. So an intertemporal no arbitrage condition holds, where the Brazilian investment equals the Thai investment when converted back into Brazilian real. This condition is known as covered interest parity, or the CIP condition. The CIP requires that we know the forward rate, but recall that it is a derivative whose value is derived from the underlying asset, in this case the spot or current exchange rate. So if we go ahead to rearrange the CIP, we would have an expression for the forward rate, and this is given by the current exchange rate multiplied by the ratio of the future value of the Brazilian investment to the future value of the Thai investment. As a brief example, if the real baht exchange rate today is 0.01, then given the interest rates we had previously, the forward rate is therefore computed to be equal to 0.0098. Interestingly, the forward rate is determined by the CIP condition. In other words, if the Brazilian investor was considering a Thai investment and wanted to cover his risk by purchasing a forward contract, such a contract would offer a rate of 0.0098, such that in a year's time, what he obtains from the Thai investment when converted into Brazilian real is the same as what he would have obtained if he chose instead to invest in Brazil. Now let's modify our analysis a little bit. Suppose instead that Thai banks raised their interest rates to 12%, while the spot and forward rates were still at 0.01 and 0.0098 respectively. Then immediately the Brazilian businessman realizes that the Thai investment is more attractive if he goes ahead to purchase the forward contract. If he invests in Brazil, he obtains 5.4 million real in a year's time at the 8% interest rate. If he converts instead his real to baht and invests in Thailand, he obtains 5.488 million real after converting back to Brazilian real using the forward rate. Of course, such opportunities for arbitrage across time are also fleeting, as either the forward contract ultimately gets adjusted or the increased demand for baht today in order to invest in Thailand causes the baht to appreciate. That is, the spot real baht exchange rate rises. This in turn will reduce the rate of return on the baht deposit in Brazilian real until it equals the rate of return on Brazilian deposits, and the no arbitrage condition is restored. As an alternative to seeking out a forward contract to cover his risk, the Brazilian investor could decide instead that he will take a risk on the Thai investment and hope that the future exchange rate will be favorable for him when he converts back the Thai deposit with interest into Brazilian real. If arbitrage does exist from this investment, then it implies that the future or expected real baht exchange rate is such that the Thai investment in Brazilian real is greater than what the Brazilian investment would have given. So if we consider our initial illustration, where Brazilian banks were offering 8% on real deposits and Thai banks offered 10% on baht deposits, and if the current real baht exchange rate is 0.01, while the Brazilian investment will give him 5.4 million real in a year's time, the Thai investment will give him 550 million baht in a year's time. Notice that he has not covered his risk, and so what that is equivalent to in Brazilian real depends on what the future exchange rate is at that time. Clearly, for the investor to be no worse off compared to the Brazilian investment, then the future exchange rate would have to be given by 0.0098 as computed. If this is what he expects the rate to be today, then he is fine if that materializes in the future, or if it turns out to be greater than that. If on the other hand the rate in the future turns out to be less than this, then he is worse off and ends up with less real than the Brazilian investment would have given him. We therefore have an expression for risky arbitrage, where if his expectations are correct, should leave him indifferent between the Brazilian investment and the Thai investment when converted to Brazilian real. This is known as the uncovered interest parity condition, also known as the UIP condition. We can rearrange this expression to solve for the spot or current exchange rate. This is given by the product of the expected or future exchange rate and the ratio of the future value of the Thai investment to the future value of the Brazilian investment. The UIP condition is often approximated by a formula that relates the interest rate in one country as equal to the interest rate in the other country plus the expected rate of depreciation in the exchange rate. In our illustration, that would be the interest rate in Brazil is equal to the interest rate in Thailand plus the expected depreciation of the real baht exchange rate. Intuitively, if UIP holds, then the two interest rates should be equal, and if there is any differential, then it's expected that one of the two currencies will depreciate over the relevant time period to ensure that they are equal. So when the interest rate in Brazil is 8% and in Thailand 10%, then if UIP holds, the expected depreciation of the real baht exchange rate is negative 2%. In other words, the Brazilian real will be expected to appreciate by 2% against the Thai baht over that time period, so that there is parity in the interest rates. The concepts of CIP and UIP both holding in the foreign exchange market suggest that in theory, the forward rate and the future or expected exchange rates should be equal, or equivalently, that the forward premium is equal to the expected rate of depreciation of the foreign exchange rate. The usefulness of these two concepts will be seen in subsequent coverage, as we recall the following. First, from the CIP expression, we had a formula for computing the forward exchange rate. That formula suggests that in addition to knowing the interest rates across the two countries, we needed to know the spot rate. Of course, the spot rate is observed in practice. However, we need to have a theory for why it is what it's observed to be. And this answer comes from the UIP condition, which we have rearranged previously to show that we can determine the spot rate if we know the interest rates across the two countries as well as the future or expected exchange rate. Subsequent lectures will take us through that interesting process of understanding how future exchange rates can be determined, along with their interest rates, and this will provide us with a theory of how the spot or current exchange rate is determined. So to summarize, our coverage on arbitrage in the foreign exchange market has brought up very interesting concepts of covered and uncovered interest parity. These are equilibrium conditions relating to financial investments across time, where the investors are either covering their risk or not, but are indifferent as to where they choose to invest. Market forces operating through rational decision-making behavior is what leads to these conditions holding, as we have demonstrated. We are now done with the introductory portion of this content on international finance. Take the quiz associated with this lecture and get ready for the next lecture that begins our coverage on exchange rate theory.